A senior precious metals analyst just said something that should stop every silver investor cold. Not a forum post, not an anonymous account on X. A named, credentialed analyst with decades in the precious metals market, Bill Holter, went on record with this exact prediction. There will be failure to deliver silver in the first part of March 2026. The currencies will zero out. It is a collapse of the entire financial system. Now, before we go any further, I want to be clear about how we are going to treat that statement because OG John AG here. This is financial warfare education, not hopium. That means we do not take any single analyst's prediction as gospel. We do not run around screaming the system is ending tomorrow. And we do not pretend that people have not made similar predictions before that did not come true on the stated timeline. What we do is this. We take the claim seriously. We look at the data behind it. We ask whether the numbers actually support the prediction. And then we tell you both sides, honestly, and let you decide what to do with the information. So that is exactly what this video is. Bill Holter's warning, the data behind it, the honest bear case, and what to actually watch in the next 30 days. Let's break it down. Segment 1. Who is Bill Holter and why does this warning matter first? Who is Bill Holter and why is this different from the average silver prediction? Bill Holter is a financial writer and precious metals analyst who spent years as a stockbroker before becoming one of the most followed voices in the hard money community. He writes for Miles Franklin Precious Metals, one of the largest physical precious metals dealers in the United States. He has been covering the COMEX delivery mechanism, vault inventory, and paper-to-physical ratios for over a decade. He is not a random account on social media. He has a documented track record of analysis, some of which has been right, some of which has been early, and some of which has not materialized on the stated timeline. That track record matters, and we will come back to it in the bear case section. But here is what is different about this particular warning. Holter is not just saying silver goes higher. He is saying a specific, verifiable, mechanical event, a COMEX delivery failure, happens in a specific month, March 2026, and triggers a chain of consequences that ends with a financial system collapse. That is a falsifiable prediction. Either March delivery fails or it does not. Either the chain reaction starts or it does not. We will know within 30 days whether the mechanical prediction was correct. And the data behind the prediction, not the opinion, the actual vault numbers and delivery data, is the most alarming set of numbers I have seen in years of covering this market. Let me show you exactly what Holter is looking at. Segment 2, the numbers that built the warning. Let's go straight to the data, because this is where the prediction either stands or falls. January 2026. Traditionally, a non-delivery month for silver. In previous years, January delivery might see 1 million to 2 million ounces standing. Normal, quiet, unremarkable. January 2026 saw over 40 million ounces standing for delivery. Read that again. A non-delivery month, 40 million ounces, when the historical norm is 1 to 2 million. That is not a 10% deviation from normal. That is a 2,000% to 4,000% deviation from normal in a non-delivery month. February followed. As of early February 2026, 18.72 million ounces had been called for delivery from February open interest of 19.11 million ounces. That is a 98% delivery rate. For context, the historical normal delivery rate on COMEX silver contracts is between 5% and 15%. Most participants roll forward. Most do not want the bars. 98% means almost nobody is rolling. Almost everybody is demanding the metal. Now add the inventory picture. COMEX registered silver, the metal actually ready and available to satisfy delivery, sat at approximately 110 to 120 million ounces when Holter made his initial warning in January. Since then, it has continued draining. As of February 27th, registered silver is at approximately 86 million ounces, a 38% decline from October 2025's 167 million ounce level in approximately 4 months. The drainage rate is approximately 785,000 ounces per day. At that rate, registered silver reaches 50 million ounces in approximately 46 days from today. That takes us directly into March delivery. Now here is the math that Holter is pointing at. March is a major delivery month. If March sees the same delivery intensity as January and February, a 50% to 70% delivery rate, COMEX would need to deliver between 200 and 300 million ounces against approximately 86 million ounces currently registered and falling. Even at a 25% delivery rate, a quarter of open interest standing for delivery, which would itself be historically extraordinary, COMEX would need approximately 107 million ounces, more than is currently available in registered inventory today, before the drainage rate takes another bite through the rest of February. That is the math. That is what Holter is pointing at. Not opinion, not prediction. Arithmetic. Segment 3. The chain reaction. Holter is describing. Now let's talk about what Holter says happens if that arithmetic produces a delivery failure, because this is where his prediction goes from alarming to systemic. Holter's sequence is this. Step 1. COMEX fails to deliver silver to contract holders standing for delivery. Step 2. COMEX's credibility as a price discovery mechanism is destroyed. Step 3. A silver delivery failure immediately spills over into gold. Step 4. A gold delivery failure immediately spills over into credit markets. Step 5. Credit markets freeze. Step 6. The real economy stops. His exact words on the final step are worth quoting directly. The real economy runs on credit. Everything you touch, everything you do. Credit has been involved in its creation. If credit becomes unattainable, the real economy completely shuts down. And on the scale of the exposure, Holter points out that U.S. total commitments and debt reach approximately $200 trillion when you include unfunded liabilities, pension obligations, and off-balance sheet commitments, not just the $38 trillion in formal federal debt. Against that $200 trillion in obligations, the U.S. holds approximately 8,000 tons of gold reserves. If you back $200 trillion in commitments with 8,000 tons of gold, you get a gold price that makes today's $200 look like a warm-up. And silver, he argues, gets repriced by the same logic. Any number being discussed for silver, $200, $300, even the $600 figure that circulated years ago, he calls laughably too low against the full scale of what a monetary reset would imply. That is the full chain Holter is describing. Silver delivery failure, COMEX credibility destroyed, gold follows, credit freezes, real economy stops, everything reprices. Is that what happens? Let's look at the honest bear case before we go any further. Segment 4. The honest bear case. Why this might not happen in March. This is financial warfare education. That means we take the bear case seriously. And the bear case on Holter's prediction is real and should not be dismissed. First, the track record problem. Bill Holter has been making warnings about COMEX delivery failure and financial system collapse for years, specifically years. The mechanism he describes, paper to physical imbalance, vault drain, delivery stress, has been present in various forms for a long time, and COMEX has managed through it every time. Not by solving the problem, by managing it. Rolling contracts, cash settlement, quiet deals, margin hikes, emergency rule changes. The fact that COMEX has managed delivery stress for decades does not mean the mechanism Holter describes is wrong. It means the institution has more tools than a single analyst can fully map, and those tools have proven more durable than predicted on multiple prior occasions. Second, the registered inventory caveat. Holter himself acknowledges, and other analysts have noted, that there are questions about whether registered inventory figures reflect double pledging or other encumbrances, which means the 86 million ounce registered figure might overstate the truly available metal. But it also means that eligible silver, currently around 360 million ounces total, can be moved into registered by owners willing to accept a premium. COMEX does not need to default if enough eligible silver owners decide the premium for registering is worth taking. Third, the rules can change. COMEX changed its rules in 1980 during the Hunt brothers silver squeeze. They implemented liquidation-only mode, Silver Rule 7, effectively preventing new long positions. They can do it again. A rule change is not a default in the formal sense. It is a managed failure that allows the institution to survive, while contract holders receive cash instead of bars. Painful for longs, not a systemic collapse. Fourth, the $200 trillion number requires context. U.S. total debt and unfunded liabilities reaching $200 trillion is a real figure when you include Social Security, Medicare, pension obligations, and off-balance sheet commitments. But those are not all due tomorrow. They are spread over decades. A silver delivery failure is a severe stress event. Whether it produces the full chain Holter describes, silver to gold to credit to real economy collapse, in a matter of days or weeks, is a much bigger assumption than the delivery failure prediction itself. The bear case is not that the math is wrong. The math is correct. The bear case is that COMEX has tools to manage the math in ways that prevent a formal default, even when the underlying pressure is real. Segment 5. What Silver Thursday tells us. Let's go to the historical precedent. Because March 2026 is not the first time this pressure has existed. March 27, 1980, Silver Thursday. Nelson and Herbert Hunt had accumulated a position in silver that represented roughly 1/3 of the world's annual silver production. Silver had run from approximately $6 an ounce in 1979 to $50 an ounce by January 1980. COMEX and the Chicago Board of Trade were facing a genuine delivery crisis. The Hunt brothers were standing for physical, and the exchanges did not have enough metal to satisfy the demand at scale without a catastrophic price move. COMEX's response was Silver Rule 7, liquidation-only mode. New long positions were banned. Only existing holders could close positions. The Hunt brothers, unable to add to their position, unable to get new financing, unable to roll forward, faced margin calls they could not meet. Silver dropped from $50 to under $11 in 2 months. The Hunts lost approximately $1.7 billion. The exchange survived. The price was crushed. The delivery crisis was resolved not by delivering metal, but by eliminating the ability of longs to maintain their positions. That is the 1980 playbook, and it is available today. The question in March 2026 is whether the same playbook can work when the delivery pressure is not coming from two wealthy brothers trying to corner the market, but from industrial users, sovereign buyers, institutions, and a physical arbitrage that has been running for months before the delivery deadline. In 1980, the buyers were speculators. Today, the buyers are manufacturers who need silver for solar panels and AI hardware and electric vehicles. You can force a speculator to take cash. It is harder to tell Samsung they cannot have the silver they contracted for. It is harder to tell an EV manufacturer their production line stops because the exchange sent them a check instead of bars. That difference matters, and it is the difference between the 1980 resolution and a genuinely new situation. Segment 6. The Coin Shop Reality. Let me bring this down to ground level for a moment, because the vault numbers and the analyst predictions are important. But what is happening at the retail and dealer level tells you something the data alone cannot. Coin shops right now are reporting a split reality. Front cases, American Silver Eagles, Mercury Dimes, pre-1964, 90% coins, moving instantly. The moment they are priced, they are gone. Dealers cannot keep specific bullion products in stock at any reasonable premium. Backrooms, sterling silverware, old jewelry, world coins, bulk junk silver piling up, refiners refusing or delaying on certain categories, dealers getting told, send us the metal, we'll email you when we're ready to lock a price. Which in plain English means, we don't want it right now and we are not in a hurry. That split, bullion flying, scrap backing up, is exactly what you would expect if the system is discriminating between metal it can use right now versus metal it cannot. Refined, deliverable bullion is being absorbed instantly. Scrap that requires refining capacity and time is backing up because the capacity is already strained. The refiners delaying on scrap while bullion moves instantly is not a contradiction of the Holter thesis. It is a confirmation of it at the micro level. The physical supply of delivery-ready silver is tight enough that the system is already rationing what it will process. Segment 7. What to actually watch in March. Here is your specific watch list for the next 30 days, all public, all free. Pull these numbers yourself. COMEX registered silver, daily. CME Group website, free, updated daily. The number to watch is whether registered silver stays above 80 million ounces through March 1st notice day or continues the 785,000 ounce per day drain. If it drops below 70 million ounces before mid-March, the delivery math becomes very difficult to manage through quiet deals alone. March delivery notices, daily from March 1st. CME Group publishes daily delivery notices. Watch the cumulative delivery demand in the first week of March. If it tracks January and February's intensity, 50% to 98% of open interest, the Holter prediction gains mechanical support. If it comes in at historical norms, 5% to 15%, the pressure is being managed. Emergency rule changes or margin hikes. If COMEX raises silver margin significantly in late February or early March, it is trying to reduce open interest before delivery pressure peaks. A margin hike is not neutral news. It is the exchange saying, we are worried about what is in the vault. Silver Rule 7 announcement. This would be the 1980 playbook. Liquidation-only mode for silver futures. If this gets announced, the exchange is telling you directly that registered inventory cannot satisfy standing demand. Price would likely drop on the announcement as in 1980, but physical premiums would explode. EFP premiums. Exchange for physical. How COMEX shifts delivery from New York to London when New York cannot fill it. If EFP premiums spike above $3 to $5, New York is paying to export the delivery problem. That is managed stress, not resolution. Shanghai premium. If the $12 gap between Shanghai and COMEX persists or widens through March, physical arbitrage continues draining COMEX registered. If it narrows below $5, the drain is slowing. Watch it daily. Outro. The honest answer. So what do we actually think about Bill Holter's prediction? The mechanism is real. The math is correct. January's 40 million ounce delivery in a non-delivery month. February's 98% delivery rate. The 785,000 ounce per day drain. 86 million ounces in registered against potential March demand of 200 to 300 million ounces. That arithmetic is not fabricated. Those are CME's own numbers. Whether COMEX formally fails to deliver in March, the specific binary prediction, depends on factors we cannot fully know from the outside. How much eligible silver do large institutional holders convert to registered at a premium? How aggressively does COMEX use margin hikes, rule changes, and cash settlement incentives? How many standing longs accept a cash premium instead of bars? Holter has been early on this thesis before. That is worth acknowledging. The mechanism he describes has been building for years, and COMEX has managed it each cycle. That track record is real data too. But here is what is different about March 2026 versus every prior cycle. The delivery intensity in January and February is not a marginal increase from prior years. It is a structural break. 40 million ounces in a non-delivery month, when 1 to 2 million was normal, is not COMEX managing delivery pressure. That is delivery pressure that has never existed at this scale before. Whether it produces a formal default in March or a managed failure through rule changes and cash settlement, either way, the signal is the same. The people who actually want physical silver are no longer a fringe minority. They are the majority of the open interest. And COMEX was not built for that world. This is financial warfare education, not advice. Size your positions as if you can be wrong on timing, even when you are right on the thesis, because the thesis and the timing are two different things. And getting the thesis right while being wrong on timing can cost you just as much as getting both wrong. If you watch this far with your brain turned on, drop OG John AG in the comments and tell me, does the delivery data change how you think about March? Or do you think COMEX finds a way through again? OG out.